Do you know that banks in Trinidad are now allowing you to do mortgages all the way to age 70 and some even to age 75? Can you take advantage of this? What are the pros and cons? Let's discuss. Mortgages that go to age 70, and here's all what you need to know. We have Kareem, who's 40 years of age. He's self-employed. He earns a salary of $17,000 a month. And Kareem wants to purchase a house for $1.65 million. Kareem has $1.75 million in life insurance, and he has an endowment for $750,000 that is set to mature at age 65. Now keep that figure in your mind. $750,000 endowment set to mature at age 65 and the significance of it. So let's say the house costs $1.6 million. Kareem has a down payment of $160,000. So Kareem wants to borrow $1.4 million. The mortgage in Trinidad usually goes up to age 65. So if Kareem was 40 years of age, salary $17,000, mortgage 1.4, the period would have normally been for 25 years. And let's say we use an interest rate of 5%, the monthly installment would have been $8,475 a month income. Now this installment is almost 50% of Kareem's income. Now remember, I told you guys the bank use something called a debt service ratio. This is the percentage of your salary the bank would allow you to pay in either a loan or a mortgage. So if it's 50%, the bank won't allow you to pay a loan or a mortgage if it's the installment is 50% of your income. But let's look if it is we was to extend that mortgage period beyond 25 years to maybe 30 years or 35 years. Now let's say Kareem does the mortgage to age 70. The figures will look like this. Kareem is 40, salary 17,000. The period will now be 30 years. With the same interest rate of 5%, the installment will drop to $7,730, which is 45% of Kareem income. But let's say he was to do it to age 75, his salary will be $17,000. Again, period 35 years, interest rate remains the same. It now drops to $77,230, which is 42% of Kareem's income. If the bank uses a debt service ratio of 45%, he may qualify by doing the mortgage to age 75, but he won't have qualified if he would have done the mortgage for 25 years or up to age 65. So taking the mortgage to age 75 allowed Kareem to pay a lower installment and hence allowing him to qualify because it would have kept his installment below the bank debt service ratio. Now this is not an uncommon thing. Bank has been doing it now for car loans, where it is now you can take a car loan for 10 years. So now they're extending the period in which you can qualify for a mortgage, which is important to know. The disadvantage is that at 65, you still be owing $687,000. Now that's a lot of money to be owing at that age. However, remember the key point is that he did an endowment to age 65, which was set to mature, and he would have received $750,000. That would have been enough to pay off the mortgage. So he could have taken advantage of doing the mortgage for a longer period, but he could have strategized in terms of how it is he could pay it off before the period. Key point. And of course, the disadvantage in that is that that money could have been used for his retirement. He didn't have to use it to pay off the bank. But the advantage is that the house is now debt free and the house would have gone up in value since he would have purchased it 25 years ago. So not all banks doing this. I believe most of the banks are. So this is something that you need to take into consideration when it is you're doing your mortgage, but making sure that you have the right strategies in place to pay it off because you don't want to be 65 and you can't pay that mortgage installment. Now, the endowment can definitely help because it's guaranteed. It's something that you can take advantage of. Hope you guys saw value in this.